In the digital asset space, you're really looking at two totally distinct paths. Look, most people chase hype. We build legacy. Most people follow noise. We build kingdoms. This is our vision, beyond the limit.
Welcome to this explainer. Today, we're looking past all that fleeting retail noise that completely distracts the masses. We're zeroing in on the permanent, bank-grade infrastructure being laid down right now, in real time. We're going to uncover how true financial empires are being constructed beneath the surface, literally brick by digital brick. If you're an architect of tomorrow's capital systems, well, you're in exactly the right place.
Section 1. Vision. Noise versus legacy.
So this fundamental dichotomy pretty much defines the modern digital asset space. On one side, we've got this chaotic, high-risk casino of meme coin launch engines, just burning through retail capital for temporary speculative entertainment. It's a game. But on the other side, we are observing the absolute dominance of incoming Japanese megabank stablecoin systems. One is designed to extract wealth through pure gambling, and the other? It's designed to store, secure, and move it at a massive institutional scale. As builders of legacy, we have to recognize that while noise definitely generates volume, only infrastructure generates permanence. True capital doesn't play games. It seeks unshakable foundations.
To really ground our strategy in macroeconomic reality, we have to look at the numbers actually governing the globe right now. We're operating within a $2.2 trillion global crypto market cap. That's massive. Yet, gravity still persists. With a May CPI of 4.2%, traditional capital is remaining defensive, and asset prices are facing continuous pressure across the board. But here's the crucial insight. Serious infrastructure expands precisely when capital flows are defensive. The architects of tomorrow's financial systems, they don't wait for the euphoria of a bull market to act. No, they build in the silence of the bear market. They use disciplined capital allocation to forge systems that are going to absolutely dominate the next decade.
Section 2. Infrastructure. Bank-grade rails.
Japan's absolute financial titans. We're talking MUFG, Mizuho, and SMBC. They aren't just experimenting on the fringes anymore. They are actively architecting live commercial transactions for fiscal year 2026. And they're doing this utilizing jointly issued stablecoins, backed by an ironclad trust structure. At the exact same time, the New York Department of Financial Services is proposing regulatory frameworks that strictly align with the Federal Genius Act. What we are witnessing is a profound evolution. Stablecoins are shedding that original identity of just being mere exchange liquidity. They're maturing into the ultimate regulated settlement infrastructure for the global banking layer itself, literally replacing legacy clearinghouses with instant, programmable settlement.
And this regulatory maturation, it extends far beyond just stablecoins. Prediction markets are starting to capture massive institutional capital. They're acting as these really powerful, decentralized oracles capable of forecasting incredibly complex geopolitical and economic outcomes. In response to this huge influx of value, the Commodity Futures Trading Commission is actively stepping in to design the regulatory architecture. They are bringing necessary order to a rapidly expanding, yet currently kind of chaotic sector. It's all about ensuring that as these prediction engines integrate with global finance, they actually operate within a structured institutional framework.
Specifically, the CFTC has proposed strict reviews for event contracts touching on sensitive global events. Contracts based on gaming, war, unlawful activity, terrorism, and assassination are now under intense regulatory scrutiny. Now, while price discovery is an incredibly powerful tool for capital allocation and strategic hedging, true enduring markets absolutely require boundaries, right? Not every global tragedy or illicit act should become a tradable financial contract, right? Acknowledging and respecting these boundaries isn't a limitation, it's the hallmark of a maturing institutional-grade market structure, one that actually protects its participants and preserves the integrity of the broader financial ecosystem.
Section 3. Tokenization. Real ownership matters.
We really need to draw a stark analytical line separating assets in this new digital economy. On one side, we've got synthetic cash-settled exposure vehicles. Think of them as basically digital IOUs that mimic price action but offer absolutely no underlying substance. On the other side, we have meticulously tokenized assets that grant tangible voting rights and genuine dividends. Listen, pretending you own an asset through a speculative derivative is a dangerous illusion, and it leaves your treasury entirely vulnerable. Real power in any financial empire demands real ownership. True equity just cannot be synthesized. It has to be legally bound and cryptographically secured.
And we're seeing this exact standard being tested right now. Platforms like Bybit are launching IPO Express products for highly coveted assets like SpaceX. But here's the thing. The ultimate test for tokenized equities isn't simply providing retail access. It's a complete, unequivocal disclosure of holder rights. As visionary investors and builders, you have to demand total transparency. You need to know, without a shadow of a doubt, exactly what legal rights, claims, and protections sit securely inside your digital vault. Because anything less than complete transparency is simply another form of counterparty risk, just masked as innovation.
Section 4. Execution. AI meets Web3. We're accelerating away from all that hollow artificial intelligence hype straight into the era of autonomous on-chain execution. Consider MetaMask's launch of agent wallets. These combine strict self-custody with complex, programmatic spending rules driven entirely by AI. Then you look at Morpho, who successfully secured $175 million for an open credit network. Meanwhile, Avalanche is out there actively integrating traditional finance pipelines using AI for sophisticated underwriting. We're seamlessly delegating these intricate tasks, things like high-frequency trading, real-time risk assessment, and continuous network threat scanning, to autonomous agents. Capital isn't static anymore. It's becoming an intelligent, self-executing force capable of defending and multiplying itself.
Section 5. Bitcoin infrastructure. Sophistication over hype.
To really understand the undisputed king of digital assets, we have to strip away the forced narratives and examine the raw market realities. The CME is now offering volatility futures, which gives institutional treasuries a regulated traditional avenue to trade Bitcoin volatility. Simultaneously, Circle's Seer BTC is bringing one-to-one backed Bitcoin collateral seamlessly into Ethereum's decentralized finance workflows, unlocking immense liquidity. Conversely, we're seeing highly promoted projects like Botanix winding down. That proves that a brand name alone just cannot guarantee a real user base. The lesson here is absolute. Wrapped assets and highly sophisticated volatility tools matter far more to institutional treasuries than forcing programmable DeFi narratives onto Bitcoin's base layer.
Section 6. Trust. The ultimate discipline.
An empire is literally only as strong as the vault that secures its treasury. Recent exploits, like the profound vulnerabilities we saw in Humanity Protocol and the controversies surrounding meme coin bounties, represent absolutely unacceptable failures in basic operational trust. These are the explicit symptoms of weak, rushed infrastructure. A kingdom simply cannot stand on compromised foundations, and institutional capital will permanently flee from systems that cannot guarantee basic security. To command capital, you must first demonstrate the capacity to protect it against all vectors of attack. Period. Which brings us to the ultimate standard, operational discipline. This means the strict adherence to transparent capital frameworks, impenetrable security, and long-term ecosystem building, prioritized entirely over fleeting attention-seeking. The premier projects in the space, they're maturing into undeniable, globally recognized infrastructure companies that are going to outlast any market cycle. The weak, however, well, they just remain mere attention machines, generating clicks, extracting liquidity, but producing zero lasting value. As stewards of capital and architects of legacy, your survival depends on knowing the difference and aligning your treasury exclusively with discipline.
As we close this explainer, I want to leave you with a critical macroeconomic question to ponder. As this whole digital economy matures, is Bitcoin's future truly about native decentralized finance? Or is it fundamentally about serving as the ultimate collateral, the bedrock market structure for an entirely new global order? I want you to think deeply on this. The infrastructure is being laid right beneath our feet. The rules of the next century are being written today. Stay disciplined, beyond the limit.